welcome to this India series discussion. Delighted to be back with some more content from India. We are going to be discussing over the next 60 minutes the recent India budget. We've got an expert panel lined up. We're also going to be looking at implications from the budget and just generally looking at the common planning themes and topical matters that occur for cross-border global Indian families. So really looking forward to a terrific discussion ahead. As always with PCD content, we love to get the comments and feedback coming in from our audience. So do put the comments in the chat function so that we can get those comments and questions to our presenters and panel as we move through the discussion. So I hope you enjoy the next hour ahead. And without further ado, we've got so much to cover. We've got so many great panelists. I would like to hand over to Kuntal Dave, who's going to moderate the session and guide us through the conversation today. Welcome, Kuntal.
Thank you, David, so much. And I also welcome all the participants to this fantastic India series. And I hope all of you are doing fine. And I think we are very tight on time-wise. So I'll straight away jump into the structuring is that we'll have Rahul from Barclays Bank first give an overview on macroeconomic scenario as tabulated by the finance minister in the recent finance bill in the recent budget. And also probably he can give us some overview and his sense of how this budget proposals can have some impact when it comes to cross-border activities by private wealth and by the HNIs. Over to you, Rahul.
Thanks, Kuntal, and thanks, David, for having me. So the budget, obviously feels a long time back now, given that the situation globally has been changing. But I think the broad message that we took away was that there were two key themes. One very much centered around the idea that there's going to be more spending on infrastructure. So effectively growth underpinnings was a very critical part of the messaging. And then on the tax policy itself, I felt that there was a fair amount of continuity. Right, that there was not a lot of tinkering, as we used to call it 3-4 years back. And the broad message was that if the economy is doing well, the broad direction of travel for taxes in India is going to be stable. And you're not necessarily going to see a lot of major changes coming about, which will give some element of certainty. Right. And this, I think, has been a feature of the government for the last couple of years, where since the corporate tax cuts were cut in late 2019, we have seen the government trying to simplify its tax structure. And, we have seen a series of changes as far as the corporate taxes are concerned. They introduced the new regime on the personal income tax side as well. And then there's been a push to try and simplify the indirect taxes as well. Right. And recently we had also heard the Revenue Secretary speak about, the next big priority is to actually sort out the capital gains taxation regime in India, which is now, I would say, fairly convoluted given the fact that there are new asset classes emerging and the government has, pretty much designed its own policies for every single asset class. So there's a need for harmonization. So I think the broad thrust, being around growth and given the macroeconomic scenario itself, where India has had a reasonably strong recovery in the last 6 to 12 months, while the idea was that it would be a bit stronger, and recent headwinds, particularly around higher energy prices, is going to maybe put a bit of a dampener. But then I think for India to achieve about 7 to 8% growth in the next couple of years and have inflation broadly in control around 4 to 6%, I think should not be a very difficult challenge. We might see some monetary policy tightening, we might see some fiscal belt tightening as well. But to a broad extent, I think India actually looks to be a reasonably stable destination for investments. And, that really shows up in the way our foreign reserves have also been evolving, right? So India has accumulated over $630 billion of foreign reserves. So in an environment where energy prices are rising and our current account deficit is going to widen, I think the probability of the rupee weakening materially is very low, which is a new dynamic, compared to the past episodes where the vulnerability of the currency to, big spike in oil prices has been very high. We are not seeing the same right now. In fact, just this morning, I was talking to my trader about how, it does feel like that the rupee has found, some degree of additional stability from the big amount of reserves that the Reserve Bank is holding. And that should provide some comfort as well. I think the other couple of themes, that were very interesting in the budget from my perspective was that the budget was geared towards identifying investment opportunities in new areas, right? So whether it is in electronic mobility, use of drones, use of production linked incentives. Just this morning I was talking to somebody from the electronic sector, and there's a lot of exciting stuff happening as far as India's manufacturing activity is concerned. I think there's also a fair amount of emphasis at the moment on trying to make India's agriculture sector more competitive at a global level. So you will see more initiatives being rolled out to try and support that. And what I also feel is that over the next, say, 3 to 5 years, we have already seen that the global scenario has been fairly turbulent, and the volatility levels are not going to be coming down materially. I think there will be tensions lingering in the background. India, with its stable political regime, with the stability that we have in our economy, and if you add the recent market stability, particularly in the currency markets, I think it makes for a very compelling investment destination, at least as far as diversification is concerned. But then also, the possibility of alpha being generated just out of the sheer demand. And one of the theories in economics which is very powerful is the idea that a country, when it crosses around $2,005 in GDP per capita, tends to see a big increase in spurt for discretionary consumption, both for goods and services. So India is on the cusp of that, and I think over the next decade or so, you will see a fair amount of money, both domestically and internationally, coming to India, which will lead to very large scale productivity gains. So as an economist, I remain reasonably certain that India's growth potential is still reasonably robust, even in an environment where the global headwinds are rising. But given India runs a largely closed economy, the ability of these headwinds to completely derail the growth story is limited. And if the government remains broadly on path of maintaining macro stability, you will probably see the gains accruing over the medium term, where the compounding effects are going to be fairly powerful as far as the investment thesis is concerned. So with that, I'll hand it back to Kuntal. Thank you.
Yeah, thank you, Rahul. So I think it's very, very heartening to note that, and I think this is also going to bring in focus the important role which global Indian families are going to play, and that's where now we come to our today's discussion. We're trying to see how the recent developments, whether India or outside of India, is going to influence the activities, cross-border, especially activities of global Indian families. So before I start, I think I'll just briefly introduce our today's expert speakers who are going to share with us their rich experience on this subject. So we've got Shreya Rao from India. I've got Nirav Shah from Dubai, Sunita from Dubai, and I've got Hetal from UK, London. And they all are going to share their knowledge and experience on this subject. And if you see how the Indian global families have evolved, can you just move to next slide, Ria? You can just try and give some overview of what we will try and cover today. Maybe we can have some quick understanding of what we have witnessed in past 2 years and what can be a trend as we go along in this particular cross-border activities by global Indian families. I've seen one of the direct impact on COVID, especially on the ultra high net worth individuals or global Indian families, have been that they are very mindful about their strategies and structures for wealth management and protection. And we have seen personally that in past couple of years, the subject of family wealth planning or estate planning, which was kept on back burner, has suddenly taken a very important role. We have seen increasingly clients reaching out to us, seeking advice, seeking help, not only locally but also going outside of India and seeking their help. And we have seen real flow of funds going outside of India. If you look at last 2 months data of RBI, we have spent close to $5 billion between December 21 and January 2022. And out of that, LRS outflow has been something close to 1.8 billion. So Shreya, looking at this personally, have you seen a sudden increase in the overall dynamics of investments or the cross-border activities by global families? And that also brings me to the slide number 2, the first poll question. I would request Ria to put the poll question for the participants to respond. And Shreya, maybe you can share your experience of how you have been experiencing discussion with your clients, and if you could also identify top 2-3 jurisdictions where they are looking to set up their structure.
Sure. No, I absolutely agree with you that particularly after COVID, families have started thinking about their personal side in a more structured manner. I think in addition to COVID, there have been a few other developments over the last couple of years. So for example, the Insolvency and Bankruptcy Code, which introduced a bunch of creditor-friendly provisions, compelled families to start thinking more seriously about segregating their personal and business assets. So historically, what used to happen is that if it was a family business, everything that the family made would go back into the business, and that segregation was not really maintained. But now families are thinking more seriously about their nest egg and how they save for what is important for them. That has also resulted in the increase of family offices, which again compels families to improve their internal governance, wealth planning, think about succession, all of those things. And outbound investments are, of course, a very significant part of how they diversify. So I would think LRS remittances increasing would be the result of a combination of all of these factors, and the fact that families are now becoming more savvy than they were in the past. I think in terms of key jurisdictions, there has historically been a preference for countries that families are familiar with. So where you tend to see a lot of Indian diaspora, right? So the US, UK, the Middle East, we've seen a lot of activity in those jurisdictions. But of late, we are also seeing families starting to look at investor visas. So some new countries have started opening up on account of that. So we see a lot of interest in Portugal, for example, Spain, countries that have good investor visa regimes where families will look at putting in money as well.
Sure, thank you. So that's something I think one can understand the likely trend, and that's going to be increasingly making very important for the families to look into the applicable laws and keep themselves ready for the future activities they would want to pursue. So if you move to the next slide, where we are trying to bring some overview of some data, I think we can skip this, that how India is emerging as a hub for a lot of ultra high net worth individuals coming in play. Next slide, Ria, please. And also, I think next slide refers to the ODI, which I just referred to you, and also LRS. Next slide, please. And this brings me to the next question, and which is, I think, most important for the discussion which we are trying to have now, is from the perspective of the global Indian families when they are looking to set up their structure, or when they are looking to obtain residency visa or an entrepreneur visa. What is the biggest challenge which they face? And I think I'm sure the audience will be probably selecting all A to D as well, because these are real key challenges, important issues which always comes in the discussion stage when they are planning to set up something outside of India. So whilst I encourage the participants to give their response to this question in the chat box, maybe a quick comment from Hetal to start with, just an 360-degree view and very macro overview of what would you think of can be the biggest challenge for Indian families looking to set up something outside of India.
Thanks, Kuntal. I'll actually take this in reverse, because what tends to come up as a really important challenge or something that's a key issue is typically inheritance tax. And that's often driven by the fact that headline rate is 40% on global assets for UK when thinking about the UK's inheritance tax regime. But actually, what I found is working with global Indian families in particular, this tax in particular can be managed with the right advice and the right structures in place. So for those families that are relocating to the UK and in their first sort of 15 years of residence in the UK, there are significant opportunities to look at trust structures to really shield assets outside of the scope of inheritance tax. in the longer run. But we also see a lot of use or reliance on domicile, and in particular the India-UK treaty with respect to those that are long-term residents in the UK. So to the extent that inheritance tax is a hard-hitting tax, but actually can be managed with the right sort of structures in place. Another point is actually where you have sort of matriarch, patriarch in India with children residing in the UK or relocating to the UK. In that first instance, they won't be subject to inheritance tax when they inherit assets. But by that point, they may have become more longer term residents in the UK. And so we encourage discussions with families to actually think about trusts in terms of the context of their wills and assets passing into trust as opposed to being inherited directly by beneficiaries that are residing in the UK. In terms of the other challenges, I would say the sort of entry points into the UK, and I think this echoes from what Shreya has mentioned, is the UK's investor visa has a higher entry point and has recently, from political or politically driven reasons, been taken away sort of almost overnight. There are other routes for immigration into the UK, being the innovator and the sole representative visa, which we've seen family offices in particular consider. But in terms of Europe and Portugal, Spain, other jurisdictions coming up as options from that perspective, we're also seeing similar conversations as an entry point, but typically it's with a route into the UK from a business perspective. And what we do notice is sort of from a repatriation of funds perspective, yes, the LRS is very limiting, but actually with families becoming more global by very nature of this conversation, we see people rely on the non-FEMA residents and the 1 million plus current income, and really actually exploring how current income can be increased in the shorter term with a view to taking assets outside of India, but potentially not bringing them into the UK tax net and relying on the remittance base of taxation. So I think out of the sort of various challenges, inheritance tax probably one that can be managed the most. And actually things are really driven more by the residency and then looking at diversification of asset bases outside of India.
Yeah, thank you, Hetal, for that quick update. Sunita, you advise on legal matters to your clients, especially to many Indian clients. What has been your experience with regard to the challenges which are perceived by the client, whereas as an advisor, what you would think are the real challenges which the client should be focusing on, and how many of these challenges are actually something which can be addressed by proper advice and planning?
Thank you, Kuntal. Good afternoon and good morning to everyone who's joined us today. I obviously will only be commenting in respect of what, as Kuntal said, I see firsthand here on the ground in the Middle East and in particular in the UAE. Challenges, of course, there are many. I think one of the biggest challenges is that the fear of the unknown, and clients always asking us to give them finite solutions. And if we've learned anything from the pandemic, it is that all clients must learn to live with a degree of flexibility and to always have a plan B. And whether that means in terms of decision-making, ownership of operational assets, ring fencing and protecting wealth, segregating, as Shreya absolutely pointed out, which is a very big aspect of our work, where we're trying to get clients to understand the difference between family-run businesses, where families have actually used perhaps the business as their personal bank accounts from time to time because it's all within one unit, and now getting the next gen involved. And as you seek more and more professional advice and global advice, it's an educational process for the family to understand the streamlining, the segregation aspects, separating ownership, protecting key personal family assets so that if, God forbid, creditor liquidation type situations do crop up, the family is always going to be protected for that rainy day. What I have seen as recent as just a few days ago, you've all probably been watching the new trade agreements that have been signed between India and the UAE, again with a very positive emphasis on pushing trade between the countries, doing away with taxation, importation of at least 97% of classes of goods from India to the UAE, which is going to help the Indian economy tremendously, and of course, vice versa. What does that mean in the terms of the conversation today? A lot of the families that are offering services or businesses are within those key 1,000 listed sectors. I think if at all anything, should be waking up and thinking about, well, should we set up some kind of a trade hub within the UAE, take advantage of that, take advantage of the tax-free fiscal regime that we have that affects individuals. I know there was a lot of fear-mongering going on in terms of the new corporation tax that was to be introduced. OECD, of course, had put down a minimum corporation tax level of 15%, and the UAE has chosen at this point in time to propose an introduction at a lower rate at 9%. Now, again, understanding that that has not yet been implemented, we have made the announcement. We are yet to look at the devil of the detail, i.e. the legislation as and when it comes out. Certainly should not be a reason for concern. Why? Because in terms of double taxation treaties, withholding tax aspects, situations such as that, where it doesn't necessarily need to affect the ultimate bottom line for a family-run business. If at all anything, I think it's a very positive change because it is a lower rate. Inshallah, as they say here, it will stay at 9%, and that, if anything at all, will give a lot of trading families reason to think about perhaps reshifting. The other good thing that we have here in the UAE is, of course, unlike other jurisdictions, such as Hetal mentioned in the UK, getting residency or nationality. Here, the UAE during the pandemic, if at all anything, has really proven that it is here for the long run to look after its citizens, its residents. We have a whole flurry of legislation that's been introduced over the past 2 years, which are encouraging inbound investment, encouraging families to come, invest, and no longer look at the UAE as a transient hub or a transient expat type 5-year turnaround post, which is what most of the kind of Hong Kong, Singapore, UAE type cities are always looked at, but actually getting people to come down and put down roots, invest in society, create something long-term. With that comes visa incentives such as golden visas, such as retirement visas, freelance visas. The hurdles that I would say that were here perhaps 10 years ago that truly were in practice somewhat detrimental, and they really were a hurdle for people to get their heads around, those have all been done away with. The other very interesting change on the Indian budget in relation to the indirect kind of endorsement of the existence of a cryptocurrency industry, shall we say. Immediately after the budget was introduced, I've had a flurry of families reach out directly through their advisors, through Magic Circle firms, saying, we're offering services incidental to such industries. And actually, whilst they're clarifying matters in India, which I'm sure is going to happen next, can we start offering those services from outside of India? So there's a whole host of positive trade, bilateral trade, global trade, that I think is obviously here to stay and here to benefit many of us.
Sure. So we are going to separately talk about this crypto tax, which has been proposed in the budget. And also we're going to touch upon the proposed corporate tax at UAE. But it's good to see that there are many more opportunities which one can avail by looking at UAE as one of the destination for them to set up their family office. I like to bring in Nirav now, who is a tax advisor based at Dubai. Nirav, what is your take when it comes to challenges which are listed for poll question 2, A, B, C, D? Which one do you think is manageable looking at UAE as a jurisdiction?
Thanks a lot, Kuntal, and good morning to everyone and good afternoon. See, in last 1.5 years through the pandemic, lot of families have started looking after, like Shreya said, what other options do we have, you know? And therefore they looked at whether do we want a second home outside? Do we want to create a kind of a security, somewhere outside of India for us to operate and be from? Or do you actually want to expand your base and create another base outside of India? So these are all three different type of queries that we saw consistently. I don't think the uncertainty of tax incidence is so much of an issue. And like Hetal also said, that inheritance tax can be managed with proper planning and advice. It's more about the other two, which is securing the right option for them to be based out, and then of course to work around the restrictions that you currently have within FEMA, and how do you actually make that work for you, and that has been the driver of how do you plan actually for them, you know and that has been leading them to look at different options, be it citizenship or be it non-residency, or moving to becoming a non-resident, and all of that kind of comes as an option, but that's, I think BNC is much more a driver than I would say A or D, and that's what
All
we
right.
have seen consistently in past 18 to 20 months.
Great, great. Thank you, Nirav. And I think with this little overview from all three experts and also from Shreya, I think Ria, can you move to the next slide, please? It is clear that it would require every families or every individual trying to set up something outside of India to carefully take into account the applicable regulations and relevant regulation, not only of India, but also of other jurisdiction. And then thereafter, they will have to come up with a solution which can fit into their requirement and which can provide them tax efficient as well as legally compliant structure. So if you look at next slide, please, Ria, we are just looking at a typical structure which an Indian family can consider when they set up their structure or when they are looking at doing a family office. On one hand are the legal statutes, for example, income tax law or treaty rules, or the rules which are applicable for foreign exchange transactions. And then there are also some commercial transactions, commercial consideration, which will have to be also be considered by the family before concluding a structure. At this point in time, let me then ask Shreya to give her view and in her experience, what are the typical structures which families would be looking at, looking for implementing when they're looking to set up something outside of India? Just broad overview, may not be something which can be exhaustive.
Sure. So thanks, Kuntal. Yeah. So, Kuntal, I would just like to pick off a point that that's been brought up before in relation to how people typically look at outbound investments, and I think Nirav and Hetal both mentioned this. Now, to be honest, in India, when you're looking at outbound, tax is less of a driver than the regulatory issues. Tax is one of the considerations for sure, because planning for taxes will be a part of everything else that you're doing. But in terms of how structures operate, they tend to be driven more by regulatory considerations than anything else. I think there are three primary options that you're looking at from a regulatory perspective. One is, if it's an individual who is sending out money, it would be the liberalized remittance scheme, which limits individuals to $250,000 per financial year. The second is the overseas direct investment scheme, which families also use for their investments. Now, the ODI scheme has certain limitations. So, for example, the overseas entity has to be an unlisted entity which is carrying on an eligible business activity. It cannot be a pure investment company. It cannot be carrying out a real estate business or be engaging in financial services. What this means is that if you do want to invest in anything that constitutes financial services, you have to be a specific kind of entity and you have to approach the RBI for approval. So, for example, if you're a non-banking financial company or a core investment company, which are regulated entities in India, they can approach the RBI for approval to make the kinds of investments which ordinary ODI entities would not be able to. Now, this approval is provided on a discretionary basis, and you have to meet the RBI's requirements in terms of how it would be provided, but it is one of the options that would be available, and increasingly an option that families are looking at in terms of diversifying their overseas investments. The other factor to keep in mind while putting these structures in place is that the ODI route is primarily available for Indian companies and Indian limited liability partnerships. It would not be available to an Indian trust, for example. And similarly, if you're looking at an overseas entity that is a trust or a foundation, so in the Middle East, for example, as Sunita will come in on, there is very frequently a preference for foundations over trusts. What you need to evaluate at that point is whether the Indian person who's making that investment can even send money into this overseas trust or foundation under the currently applicable regulatory regime. So under the ODI route, you would not be able to do it. Under the LRS route, there is a view that it should be possible for trusts. For foundations, the issue that you would have is you would not know whether to classify the foundation as a trust or a company for the purposes of the Indian regulatory regime, because theoretically it is a hybrid. So it does have a fiduciary management concept similar to a trust, but it also has legal personality similar to a company. And that makes it tricky to classify from a FEMA perspective. I think what we end up doing when we are working with families in relation to this gamut of structures is figuring out which of these options makes the most sense given what the family wants to do. So for example, if the family came to us and said, look, we want to invest in an unlisted company outside India, take a strategic interest, $250,000 is not going to be sufficient for us, then we would probably say that you could set up a company or a LLP in India and do this under the overseas direct investment route. If on the other hand, it was an individual who came and said, I want to buy listed shares in Microsoft, it would not be possible under the ODI route. You would have to do it within the LRS limits that are available to you. And similarly, if you're talking about an Indian individual who is relocating abroad and therefore able to use the additional limit, the $1 million limit that is available to capital, what you would typically do is you would try and restructure their portfolio before they move so that they get more income out of whatever they hold, because income is freely repatriable. So while this structure is broadly, it is one of the broad structures that we would look at. I think in terms of the nuance, in terms of whether it would be a company, LLP, whether there would be an overseas trust, foundation, how much you're able to take out of India, whether the underlying investments are investments, hedge funds, so some of these other points that you've put on your slides, the final structure would really end up depending on the specific requirements of the family and what is possible from an Indian regulatory perspective, while at the same time also looking at tax consequences in the home jurisdiction. So for example, Hetal will probably weigh in on how if they wanted to buy immovable property in the UK, then on the Indian side, the issue would be that an ODI entity cannot do what is called a real estate business. So we do have entities buying office property, for example, as part of the other operations that they're carrying on. But how would that make a difference from a UK perspective in terms of a tax on envelope dwellings, higher stamp duty? So that would be a part of structuring on the tax side that you would also need to do in the home jurisdiction.
Yeah, thank you. Yeah, that's right, Shreya. I think we'll have to look at the laws of both the jurisdictions and then come to a right structure. And I think what comes out from your brief introduction is that depending upon the family structure, family background, and their existing business operations, we'll have to see mix of LRS, ODI, and depending upon what kind of activities they want to pursue, it could be further done under LLP structure or a company structure. I think that's important. And I think this is something which would be a starting point for any Indian family trying to set up something outside of India. And which also brings
on. Sorry,
Yeah,
I just wanted to interject there.
Yes.
And actually, with the greatest respect, not say that should be the starting point, because it can't. And again, with the greatest respect, what I do find is actually the proper way to address cross-border mandates is first and foremost getting our clients to understand that it has to be a collaborative advisory approach. We have to explore options. We have to understand what are the objectives. We have to understand who's in the family, where are the family now, and possibly within the next foreseeable future, whatever that window may be, and what may be the implications of various geographical placements. And then, because we collaboratively advise, so for example, it would be Shreya and I working together. Shreya would work with the Indian family. I would sit here advising on various options in terms of potential exit or resettling the family wherever it may be. Nirav would come in and advise on the tax side of it. If the family wanted to pick up apartments or invest in properties in the UK or start up a holdco, use the UK, which is a favorable holdco jurisdiction, we would rope in Hetal and so on and so forth. But there's one thing that's really fundamental for today for all clients and advisors to understand, and that is you cannot jump from one place to another without actually having the full-on detailed analysis, and that takes time. And that is really what provides the roadmap for the clients for the next gen, because if that step has been skipped, I mean, I also find the term family office being thrown around very loosely. That's a very dangerous thing to do, because a family office serves a very particular function, but the family office does not serve the function of the ownership of assets. In terms of succession and wealth preservation, the ownership actually has to be depersonalized. That's the essence of wealth management and wealth preservation and succession. And so it's an educational process that we must take the clients through.
No, I think Sunita, absolutely right. And in fact, I have seen personally being advising client on this particular aspect for past many years. There is definitely a sense of need, and also they do it religiously. We have seen complete change in the approach of Indian clients, Indian families to take proper guidance and advice. And as you mentioned, the structures get implemented in a completely collaborative manner. It can't be looked in silos, that you just look at India and then try and find solution whether it is going to fit at other jurisdiction or not. So you are absolutely right. Collaborative effort is something very, very important for client to ensure that they are able to have a right solution and right structure at place. Shreya, you were going to make some point when Sunita...
Yeah, no, I think it's similar to what Sunita said. The point I was trying to make is that in approaching this kind of cross-border planning exercise, there is this assumption that, you know, you can pick a piece from here and pick a piece from there and then, you know, put them together and it's all going to work. And this often happens with, I mean, we have to understand that ultimately the laws of different countries are like different languages, and you need to marry them at some level in order for it to work seamlessly. And in approaching this kind of planning, I think where experience really shows is where you can anticipate issues in the other jurisdiction because you've encountered them in the past, and you translate it into the requirements of your regime. And that can only happen with adequate prep work. It can't be that, and I agree with Sunita on that, right? It can't be that you've been working on a structure on one side for for a very long time, and then you go to the offshore counsel and say, why don't you plug in your piece? Because it simply doesn't work that way. It has to be something that you do with some amount of forethought. So yeah, she got that before I did.
No, Shreya, just from a UK perspective as well, we've often seen scenarios where families come to us with a structure suggested from, for example, an India perspective, but then trying to fit it into a UK landscape is actually incredibly tricky. Whereas actually, and I think sometimes, families do go into it with the cost objective, or a view of thinking that by having a trust deed put in front of a UK advisor, so an Indian trust deed that's been drafted by Indian lawyers for UK beneficiaries of an Indian resident trust, and we can just opine on a review of the trust deed. But actually, the way we want to work with clients, and we sort of need to work with clients, is thinking about the UK and India advice before you get to any kind of implementation stage. And that really, as both Sunita, Shreya, you've all echoed, is very much a case of advisors brainstorming cross-jurisdiction at the outset. Because as you've also rightly mentioned, Shreya, I think more and more so in recent times, the regulatory concerns or sort of challenges from an India perspective are coming up more and more so than the tax perspective. So whilst from a UK perspective, our anti-avoidance legislation is probably what we have to give the greatest consideration to in terms of applying the rules or the UK legislation to specific structures that are proposed. And that's typically where we have to really look at things on a case-by-case basis. From an India perspective, what I'm finding is it's much more the regulatory points, in particular when we're thinking about trust structures. And I think the merits of trust structures in particular are incredibly significant, but only where they can work effectively for the family. So again, just to echo what you've both all said, it's very much a collaborative approach and a work in progress. There's no one size fits all is one thing that really comes about when we have families touching the UAE, India and the UK in particular.
Yeah, thank you, Hetal, for that. And in fact, this brings another important point. If you go to the next slide, looking at the discussion, it is important that there is a collaborative effort and we try and come to a solution or try and have a structure which can be most tax efficient at the same time legally compliant from all jurisdiction. Now, it doesn't end there because the regulations keep on changing. We have new laws, we have new regulations, and that makes this particular task of coming up with a structure even more challenging because of this dynamic landscape under which we operate. And there I thought, let's look at some of the recent announcements or challenges which the families are facing in today's days and time. And if I can request Shreya first to give some overview on the recent budget proposal. We have seen that in India budget, there have been few changes with concerning direct taxes, whether it is the case of extending the deadline for setting up the manufacturing setup in India, or most talked about, and which even Sunita touched upon, was taxation of crypto assets. We have seen a lot of also support coming to the units, or more and more tax concessions being extended to units which are going to be set up in IFSC, the International Financial Services Center of India. So from this budget proposals, couple of key takeaways for you, Shreya, which can be of interest for global Indian families. Maybe one of the important one could be the taxation of crypto assets. If you want to say how it will have some impact on this subject when it comes to the activities of Indian families.
Sure. Happy to. I'm actually happy to, to say that there haven't been too many amendments in this time's budget, which is also something that Rahul had touched on at the very beginning of this session. What I'm going to do, since we are slightly short on time, is broadly touch on what's been done in relation to crypto, and maybe also talk a little bit about COVID-related developments, which may not impact high net worth individuals, but they are relevant on the personal side and they're more topical.
Sure. So first you can give your views on crypto asset, because then I would want Hetal, Sunita also to respond on that, and then maybe you can move to the second topic.
Sure. So on crypto, it's been a bit of a regulatory minefield, to be honest. So there was, the Reserve Bank had tried to, it issued a circular a few years ago, which sought to restrict banking facilities from being offered to participants in cryptocurrency transactions. And the Supreme Court set that aside on constitutional grounds. But that being said, the legal status of crypto is still a gray area in India as of today. The budget proposals should not be seen to change that. Although what they have done is given us clarity in terms of the tax treatment of crypto assets for people who derive income from crypto assets. Now, what the proposed provisions have broadly done is that they have defined crypto. And the definition broadly says that crypto will mean a virtual digital asset is the term that they've used, will mean any information or code or number or token which is generated through cryptographic means or otherwise. And what they have also required is that it can be transferred, stored, or traded electronically. And it has to provide a digital representation of value or function as a store of value. Now, what they've specifically done is excluded Indian currency and foreign currency from the definition of crypto. So what they've done is, actively move towards the asset conceptualization of crypto as against the currency conceptualization of crypto. And in the tax treatment, they seem to be treating income from cryptocurrency as similar to winnings from games, so a speculative kind of activity. So they've said that any gains from crypto will be taxable without expense deductions other than the actual cost of acquisition, and there will be no loss set-offs that are allowable. Now, a couple of points that are significant to note in relation to the overall regime is that, firstly, they're also applicable to in-kind exchanges, which is also in tune with the broader capital gains tax regime in India, which is that a swap of assets could also potentially trigger capital gains. And that's also the case with crypto. So if you get onto a platform and pay crypto to buy a service or a good, for example, that would potentially be considered a taxable transaction, at least based on this Indian definition. A similar treatment would also apply if it was an exchange of crypto for crypto. Now, the challenges that come up here are that, so firstly, they've imposed a withholding tax in relation to this kind of income that is generated, which of course in an in-kind transaction, so crypto for goods or services or crypto for crypto, we need to figure out how that withholding would really apply. In a non-crypto context, what happens is, so for example, if you exercise ESOPs to get shares, which is another example of a transaction where the cash may be insufficient to meet withholding tax obligations. So if the salary is not sufficient to cover the perquisite value of the ESOP, you sometimes have employees giving a check to the employer to the extent of that tax obligation. So the market may figure out solutions to the withholding problem, but at this point, there could be a potential situation where a crypto for crypto or crypto for goods or services could result in this withholding tax issue. The second possibility is that although the tax...
So, Shreya, sorry to just intervene, but maybe if we can bring out some important point relevant for the Indian families looking at cross-border transaction, because we are running a little short of time. So maybe we can have this technical analysis of the provisions, deferred, but something which you think how this can probably provide new opportunity for Indian families to look at this particular asset class?
Sure. I mean, all of this would apply to any Indian resident family that's buying crypto. So even if they buy it on an offshore exchange, it's the same treatment would still apply. And a similar treatment would also apply if there's any Indian crypto. So the Indian government is now planning to introduce its own virtual digital currency or asset. A similar treatment would apply if non-residents owned it in India as well. But other than that, I think, the broad regime would be similar for both outbound as well as inbound kind of crypto ownership.
Yeah, so Hetal, I'd like to come and come to you because, as Shreya mentioned that the way in which India is going about taxing crypto asset is that something similar to treating that as a speculative income. There is no set-off allowed and no deductions are also available. So if India has on many occasions or by and large adopted UK tax rules on many of its income, what has been your experience at UK with regard to taxing crypto asset, and how do you think that can be handy for Indian families trying to do something at UK?
Thanks, Kuntal. So I'd say it's a developing landscape from a tax perspective in the UK when we're thinking about crypto investments. It's definitely coming up more and more so as an asset class that families have exposure to. Where it's quite interesting from our perspective is that HMRC have said that it won't treat it like gambling earnings, for instance, or lottery wins. So we are looking at crypto as an intangible asset, and it's not going to be akin to currency either. So the areas where it's actually quite interesting from a technical perspective is looking at the situs of the asset. And where that's of particular interest is global families who are residing in the UK and availing themselves of the remittance basis of taxation. It would be incredibly important if all of a sudden a gain associated with selling crypto became taxable in the UK because it wasn't treated as a foreign gain. Now, HMRC released some guidance recently which would suggest that they would argue that the crypto asset is located where the holder is resident. And that sort of goes against what we would look at from a contract law perspective, being that if the crypto is held on a non-UK exchange and traded under a non-UK contract, that the situs of the asset would actually be under the jurisdiction in which the contract is governed. So we have sort of differing opinions at the moment, but as it hasn't been tested, it's one of those that we sort of need to watch the space on and really carefully consider for each scenario. But our view broadly, and this is by no means advice to anyone specifically, is that actually, I think there are sufficient grounds to consider that the assets would be non-UK situated, as opposed to HMRC's initial sort of thoughts on this. And the other aspect, of course, to really think about, which HMRC provided initial guidance on, is very much whether or not someone is considered to be trading in crypto, in which case profits would essentially be taxable to income tax, or whether they are holding the crypto asset as an investment and therefore they would be subject to capital gains tax, which is at a much lower rate in the UK. And on this point, we refer to sort of the hallmarks of trade, which we would consider in any type of situation where someone could be challenged from a HMRC perspective, as looking at a trade as opposed to investment holding. So it's one of those that it's very much a developing landscape. I think we'll have to see cases being tested in the courts to really get a sense of where HMRC land on this. But I guess it's one that HMRC's thoughts are evolving, and I assume from an India perspective as well, it's quite similar that it's only just starting to recognize the crypto investments, I believe, from a regulatory perspective, whereas previously it was unlawful perhaps to invest in crypto, I believe, Shah. So it's one of those which I guess is an emerging sort of regime, and one that's quite interesting, I think, because it does form, as you say, part of remuneration packages, especially for startup entities in particular. So it's more and more so something that is coming up in conversations.
Yep, thank you, Hetal. And I think it's something which India may also have to revisit the present rules of taxing crypto assets, because it brings out clearly from your remarks that UK has a favorable tax system as compared to India when it comes to taxation of crypto asset. Nirav, you are also a tax advisor. Do you have any thoughts on this? How crypto assets and the proposed tax rules in India will have some impact for families at UAE?
So the fact is that India has started to be clear about its tax treatment is in fact good for some of the Indian families who are already investing into it. Now, lots of Indian families have been investing into it. They have different means of doing it. Of course, whether they are completely compliant from a regulatory perspective, whether it is within the ceiling of their investment overseas and all that, that's separate. But at least they know that for sure that if they bring that money back in, they can pay 30% and that's about it. So it encourages a lot of people to at least get into that as a separate asset class and invest into it. Now, from a UAE perspective, of course, that's not an issue because we don't have, at the moment, we don't have a tax system on that. But overall, dealing in crypto is more and more challenging, and getting it back into your bank account is even more challenging because banking system today also, like Shreya said, that RBI doesn't allow you to open a bank account. Similarly, UAE Central Bank will not allow you to open a bank account if you seem to be dealing in crypto, So these are other challenges that one needs to be mindful of. So even though UAE, some of the free zones allow you to open a company which trades into crypto, the central bank doesn't allow you to open a bank account.
Okay.
So we need to be mindful of this,
Sure. So Shreya, before we move to the second topic of impact of COVID on tax residency, since we are running against time, let me come back to you after I have got some overview from Hetal on UK changes. So Hetal, if you could, quickly, maybe in a couple of minutes, give some overview of few of the important recent changes which can be of significant interest to the global Indian families.
Thanks, Kuntal. So less changes, I would say, from a UK perspective, in the sense that we haven't had any significant tax changes for resident non-domiciliary families since 2017. And the expectation on the ground and in the industry is that there has been sufficient reworking of taxation of trusts and taxation for resident non-doms. And so that's not expected to be something that materially changes. In terms of the corporation tax rate in the UK, it's been at 19%, which has been quite attractive, as Sunita said as well, for hold companies in the UK and setting up of family offices in the UK as well. That is set to increase to 25% by 2023. It's still low compared to other heads of taxation in the UK. And so from our perspective, what we have seen emerging in the last sort of few years in particular has actually been the sort of interest in setting up trading companies in the UK and looking at expansion of what were Indian domestic entities or trading entities and groups, really tackling the UK market as a growth area. And that tends to stem in conjunction with the children of the proprietor perhaps looking to settle down in the UK. So post-education. So, I would say that previous trends typically for interest in the UK market for Indian global families was UK residential property and very much schooling, but sort of primary level schooling and perhaps university level. What I'm now seeing more of is actual long-term settlements sort of interest in terms of families having that diversification globally, but also with respect to their trading operations. And from that perspective, there are some really sort of quite fairly savvy sort of structures that will work, looking at sort of overseas holdcos with UK trading groups underneath it, giving protection for, some elements of the family. So what we're now seeing is concerns more around things like marital risk and protecting the assets as they're being passed down to the next gen and thinking about segregation through different sort of streams of the family. So sort of more sort of family-based conversations, but looking at physical relocation more and more. So I think that's probably the hottest thing that I seem to advise on, is very much the pre-arrival piece into the UK. And very much there's a lot of options that are available as long as the family gets the right collaborative advice in advance of that relocation, I would say, Kuntal.
Yeah, thank you, Hetal. I think it's good to know that there have not been many regulatory changes, but the needs and preferences of client would change, would have some new dynamics attached to the structure, and therefore they need to revisit and try and see what better structure they can have. Thank you, Hetal. May I now ask Sunita if she could, because we are running little against time, if she could give some overview of her, in her experience, there have been a growing interest in relocation to UAE. With that kind of growing interest, what do you think as an advisor are some triggering opportunities, or what are the associated challenges associated along with this relocation to UAE by Indian families? Quick 2-3 minute remarks, comments from you, Sunita.
Sure, Kuntal. I wouldn't see them as challenges, if at all anything. The UAE and in particular Dubai, should we say, which is more of an expat demographic than Emirati, is considered to be the fifth city of India, of course. There's tremendous cultural familiarity. The way of working, the way of doing business is not terribly foreign. Everything is done in business and conducted in English. There's tremendous comfort, and with that comfort comes smooth and ease of doing business. Obtaining residency here can be linked to occupation. Obtaining residency here can be linked to your net worth and how much you're actually investing here. So if you are starting up a business, it can be linked to assets that you own here and investments that you make here. There are long-term residency visa options, and all of the options, as I said much earlier on, actually, are very, very easy to access and to find information on and to do things properly. What I do see in terms of trend, and what I would say is, when thinking about relocation and whether that means relinquishing Indian citizenship in lieu of another citizenship, there are far more serious considerations there. Some of the European countries are offering tremendously attractive visa programs, absolutely. Visa programs that, again, look down into the devil of the detail. For example, would we really expect people in the ages of 60 to the 80 demographic to go over and start learning a new language if that was one of the conditions attached to something? And remembering also that the kind of golden passport that is often talked about, again, very loosely. If you look at the fine print, you don't pick up a golden passport on day one, even if you meet the economic criteria. There is a longevity gestation period that relates to a prerequisite number of days in terms of physical presence, being there for a certain number of years and days, etc. Every program is different. My point in all of this is, do the research, look into the detail. There's a lot of marketing that's going on, and what may work for one family, or indeed perhaps the younger generation in the family, may not work for the others. It's very important when you're looking to choose jurisdictions to understand how involved are the family themselves going to be hands-on. For example, here in the UAE, we have economic substance regulations we have to be very mindful of. In India, you have similar correlating issues that you all know as POEM, place of effective management. So central management involvement and the implications of having central management and direct involvement are also important to consider when looking at cross-border work. UAE is often considered as the halfway house because it's very easy from a transitional perspective, from a tax neutrality perspective, from being a hub for trade, for economic development, a gateway into Africa, the crossroads to Europe, so on and so forth. And that's what makes it so good. And now, in terms of previously, when you would have Indian clients who would get very, very confused and talk about Sharia and what do I do if I die and what have you, all of those, respectfully, those concerns can be addressed. And there are solutions to all of those concerns, because now we do have robust, tried, tested succession planning options here that are common law options and have got nothing to do with the onshore system of the judiciary. So that, all in all, actually builds the UAE as a very, very robust and competent, solid IFC. And I think that helps with building investor confidence. It'll continue to grow.
Great. Thank you, Sunita. Now, I am very mindful of the time constraint, but Nirav, before we end, I would want you to give quick comment on two very interesting and important development from UAE. One would be if you can give some overview on the new proposed corporate tax and how it is going to have some impact or influence on the structures of global Indian families where they have a UAE as part of the structure. And second, if you can also quickly share some practical aspects of securing TRC by UAE residents from tax authorities at UAE.
Thanks, Rahul. So let me quickly summarize these two important things. Corporate tax as it is proposed, again, like Sunita said, we are still awaiting the details. But what we can make out from the FAQs and all is that it is only going to be at a 9% rate, which is one of the lowest in the world. Second, it is very likely that dividend and capital gains are going to be outside or exempt from corporate tax. And therefore, your investment holding structures will not get affected. Further, I would say it's other way around, that if you want to then set up an investment holding structure out of UAE, it can make more sense because you can still access all the UAE tax treaties, which over 85 of them, And it will work like a participation exemption which you have in Europe, where inbound dividend and capital gain will also be exempt, and there is no withholding tax on sending the money out, so it can work well from that point of view. So from a family point of view, having an investment holding company, corporate tax is not going to be a deterrent. If you have a trading company, of course, the locally sourced income will be subject to tax. And therefore, we do expect the tax to be a source-based taxation, like one that you have in Singapore or Qatar or Hong Kong. And that might add another planning options once we have details available. So that's on corporate tax. On residency and TRC, one needs to apply online. There are specific and set criteria of document that they need and that they look at. For an individual, for example, they need something called an entry-exit report, which is basically your number of days presence in UAE during the visa period. So if the visa period is 2 year or a 3 year, into that 3 year period, how many days you have actually stayed in UAE. So today, while issuing TRC, they are not linking it to per year number of days spent in UAE. And as long as you have other substantial document like your employment contract, your 6-month bank statement having sufficient balances, tenancy contracts, or ownership document of property, you can still get TRC with even having spent 60 or 90 days in UAE in that year, So that depends again at the discretion of the taxing authority, where they look at overall picture and not just one or two criteria. So that's on the TRC. Again, process is simple. They've substantially reduced the fees for TRC, which they were charging, say, a year back. Now the fees have come down drastically. And those who are in fact registered for VAT purpose pay, and the corporates are registered for VAT purpose, we pay even lower fees, So it's all very simple, very easy to do it. And if there's an issue, you can always reach out to us.
Great. Thank you. Thank you so much, Nirav. And I think this will bring me to the last poll question for the participants. Ria, if you can move to the next slide, that whether you would like to review your existing structure for recent development or challenges. We heard about Indian regulations, UAE, UK. Please do let us know if you feel that having regard to these changes, there is a need for you to revisit your structure. We are already past our time. So I think, Shreya, we will not be able to, touch upon that other aspect surrounding the residency test. Maybe if we have a couple of minutes, David, do you want to look at the Q&A which we have got from the audience? And
just one question here saying, is there any change expected in the ODI regime to allow family offices to invest overseas in listed companies? Shreya from Adita.
So family office is... Yeah, family office is like Sunita said, a loose kind of term. Under the current regime, it is possible for non-banking financial companies and CICs to apply to the RBI for approval. And today it would be possible. The ODI regulations are proposed to be amended. The draft is currently out, but the new regulations have not yet come out. But in any case, that particular piece of it may not really change. We'll need to wait and see.
Yeah. In fact, David, in our preparatory discussion, we had touched this subject, but since we are running against time, we were not able to, dwell upon it. Any other question which you want us to answer?
There was a question from Priyank in London saying he's noticed a very sharp increase in demand for UK residential property in the last couple of months. Hetal, I think you replied in the comments to say that you haven't seen such a surge, but have you seen consistent demand on Indian families buying property in London, or what's your sense of that?
Yeah, it's not that we haven't seen a surge as such, but property transactions, our property teams are very busy, but it's more that I've seen relocation really surge, and I guess property inquiries as a result of that, I can imagine, have increased substantially. So yeah, I can understand where that comes from, because I do think that people are looking at the UK more from having a substantive sort of footing in the UK longer term. And I think it's sort of COVID related as well. I think in terms of those sort of resident Indian families that have thought about wanting to have larger estates, access to gardens and open grounds. There have been some push factors as well related to COVID that I think have increased that sort of interest in property in the UK, but a different type to the sort of Mayfair pad that previously was incredibly popular.
Okay, terrific. Well, we are out of time for this session, I'm afraid. Thank you, Kuntal, for hosting the discussion. Thank you so much to the panel for participating. We covered a huge amount of ground in the last 70 minutes. Do reach out to any of the panelists for specific clarification, advice, further guidance. Collaboration is really the essence of what PCD is about. So please do reach out to the panel. Thank you for joining us. Hoping to make more India content throughout the course of this year. And
Thank you.
Wish you a very good day.
Thanks,
Thank you.